Joining me today on the spot is Campbell Harvey. He's a professor over at Duke University. He caused quite a stir last year in the precious metals community with an academic paper he co-authored that suggested the fair value of gold should sit around $800 an ounce. He joins me today. Thanks so much for being with us, Professor.
Great to be on the show.
So it's now 1 year later since your famed paper came out. Do you stand by the fair value of gold being around $800 an ounce?
So what Claude Erb and I did in our paper, The Golden Dilemma, was to look at the behavior of gold over the very long term. Like I'm talking really long term, 3,000 years. So basically we came up with the idea that over the extreme long term, the real price of gold is approximately constant. And given the recent behavior of gold, where we went well above what would be expected by a constant real price or constant purchasing power of gold, that we expected a correction in the price of gold. And indeed, you're correct that our analysis suggested that gold should head back down to 800, though we didn't say when that would happen. As you know, last year, gold dropped by 28%, pretty substantial move down. Again, we suggest that the fair price is about $800, but we don't actually say when that would occur.
So we often hear that gold acts as a hedge against inflation, against the US dollar, but you have a different perspective of what the role of gold is.
Indeed. So our paper, The Golden Dilemma, actually explores these, what should I call them, stories that people tell. And the main story that is told about gold is that it's an inflation hedge. Indeed, I've visited very sophisticated asset managers controlling billions of dollars, and they will carve out a bucket in terms of their portfolio that they call inflation protect. And they'll put things in it like tips, which seem logical to do for inflation protection, but then they'll put gold in. And I said, well, why do you have gold there? Well, it is a protection for inflation. So what Claude and I actually did is to look at the data and test whether gold provides a hedge against unexpected inflation. And the evidence is not very convincing. We could find no significant relation. And even in extreme situations like hyperinflations, and we documented a number of hyperinflations, over 50 of them, that it was hit or miss. Sometimes it worked, sometimes it didn't. So this is a myth. It is a myth that gold is an effective hedge against unexpected inflation. And I would submit that many people make a mistake in buying gold expecting that gold will hedge inflation, and it doesn't. The reason is so simple, and it's documented in our paper. Gold is just too volatile. If you look at the volatility of inflation compared to the volatility of gold, it is really tiny. So gold can move way away from inflation.
But many investors buy gold expecting currencies to fail. So what do you think of that investment strategy?
So again, it's a simple matter of going to the data. And that's exactly what we do in our paper. And I encourage your viewers to look at our paper. So we look at, in The Golden Dilemma, we look at about 7 different currencies. We have another paper that looks at 23 different currencies that cover 85% of world GDP. And there is no significant evidence that gold is an effective hedge in terms of currency.
So even if there were to be a devaluation of the US dollar, would gold not necessarily perform well?
The key word is necessarily. So maybe it would, and maybe you get lucky, and maybe it doesn't. So again, we looked at a number of different situations, not just the US dollar, but international currencies. For example, we looked at a period in Brazil, a 20-year period. So not just like 2.5 years like the Weimar Republic and the German hyperinflation, but this is a 20-year period where the average inflation rate was like 250%. So it's huge in inflation. And gold, basically, you lost 60%. And if you had held the Brazilian currency over that period, you would have lost almost everything, but you wouldn't do that. You would be investing in Brazilian interest rate bearing deposits or buy US dollar. That's simple enough. So it's unreliable.
So your co-author, Claude Herb, recently came out with a correlation between interest rates and gold. He came out saying that if we look at 10-year Treasury yields, and if they rise to 5%, then gold could fall back down to around $470 an ounce. Do you agree with him?
So let's just rewind as to what that means. If you look at recent history, there is a remarkable correlation between yields and the price of gold. And we document this in our paper, The Golden Dilemma. So it basically means as the yield goes up, the price of gold goes down. And if you look at that scatter over recent history and draw a line through it, it suggests that if interest rates go to 4%, which is not unreasonable, we're talking a little over 100 basis point increase in the 10-year, and you look along that line, the best fit, then it suggests that gold would drop below $1,000. So again, it's kind of getting close to what we call the fair value. What we have also done is to look back further in history. So right now, there's this very strong negative relation. So the price of gold and the interest rates are negatively related. Rates go up, gold goes down. But if we go back, more than 20 years in history, that relation could turn the other way. So you could actually get a positive relation. So it is unstable. So if you believe that the correlation will continue like it is in the future, then it suggests that a 4% interest rate means gold goes below $1,000. However, a careful examination of history suggests that relation is unstable. So you need to be very careful.
So do you consider yourself a gold bear? Is that a fair label?
No, I'm not invested in gold, so I'm not long, I'm not short. Indeed, for me to do this research, I purposely didn't want to take a position in gold for a potential conflict of interest. Our paper is what I call kind of a balanced examination of all of these stories about gold. So saying that gold is not an effective inflation hedge doesn't mean you're bullish or bearish. We propose a model based upon the fair value that we already talked about that suggests that gold eventually should come down to about $800 an ounce.
I guess the question is, do you still see gold as part of an investment portfolio?
Yes. Okay, so in the paper, we're very careful about this, that a diversified investment portfolio should include stocks, bonds, and this is key, a diversified portfolio of commodities. Okay, not just gold, but a diversified portfolio of commodities. Gold is a small part of that, and I would not want to exclude gold from that diversified set of commodities. The paper also explores the case that if emerging markets continue to grow as they have in the past, even at a slower rate like China, there is the possibility that they might want to accumulate more gold. If you look at China's reserves in terms of gold, it's trivial. The currency reserves in terms of gold is about 2%, whereas many developed countries like the US and Germany, it's more than 70%. So if China wants to basically float its currency, to join the world in terms of potentially having a currency that's tradable and free, then they actually might consider buying more gold. That could provide upward pressure on the price of gold in the shorter term.
On that note, thank you so much for being with us.
Okay, great to be on the show.
And thanks for watching this edition of On the Spot. You can email us at newsfeedback@kitco.com or follow the conversation on Twitter @Daniela Camboni. Thanks for watching.